Welcome, everybody, to East Daily's presentation of Organically Grown, the shifting landscape for growth in the midstream sector. I don't know, I'm excited this morning. We had a big announcement with Crestwood and Energy Transfer merger. So we, of course, this morning changed our deck and added some slides there. Jay's going to talk to those, so I'm excited to bring that. We deleted some other things that we were planning to show you on some other systems in the area, but figured everyone would love to hear about the Crestwood piece. So excited to bring you this. I've got the impeccably dressed Ajay Bakshani with me. He's going to cover the financial aspects. We're going to mix some fundamentals with some financials here today and talk about really about organic growth, but also inorganic growth. And by that, we're going to leverage some of our base business risk analysis in terms of figuring out, how companies are growing in this environment without adding significant capex versus where there are opportunities or have they actually executed on adding significant capex. Ironically, the ET Crestwood merger is it's a perfect fit into this webinar. We weren't actually going to cover Crestwood, despite the fact that they register the highest number in our base business risk. Again, a measurement of organic growth, really. They are the largest company in that measurement, in that index. So it works out perfectly. Better to be lucky than good, I guess. So excited to do that with you. But first, what we'll do is just a quick introduction to East Daily for those of you that are unfamiliar with us and our background. We won't spend a long time on this, I promise. But we are an analytics company connecting supply, demand with profitability. So that's both the physical aspects of the industry to the financial aspects of the industry. I love talking about connecting the molecules to the money. Infrastructure data, market analytics. Listen, we are the customers that we like to help, and I'd imagine this is many of you, are the same people that do the same research that we do. We just prioritize that and have the time and capacity to do that, to prioritize that in our day, to reevaluate models, to synchronize across commodities, to calibrate versus company expectations, to balance across market dynamics. I mean, we do all the things that I know that many of our clients said they wish they could do if they only had the time and the resources every day to do it. And we'd love to help you do that too. We have data delivery, we have reports and presentations, we have a large analytics support team to help you guys and to help answer your questions. And then we also have a consulting wing if you have customary analysis that we can help with on that side of things. And then tons of data collection, tons of data sources as you think about how do I integrate some of this information in addition to cleaned up, normalized data that's available out in the market. We build custom analyses and custom data sets that are not available in the market. Again, we're trying to speed your efficiency and confidence in doing that. I've included another slide here. There's some links here. If you are interested in what we talk about here, whether it be company financials, natural gas liquids, crude, when this deck is sent out, click on those icons at the top there. It'll send you right to a form fill where you can request a trial or request some information from our team on whether or not we can help. There's a link there for Energy Data Studio, which is our platform. You'll see a lot of visuals in here, which we'll use to aid in the conversations. But enough of the this. You will get a copy of the presentation, as I see just came up in the questions. So that'll be sent out along with the recording. Send it to your friends if you'd like. Ask questions in the bottom. We will answer those as we can throughout the presentation if it's not too distracting, or after the presentation. We do have a ton of information to go through today. So if we do not make it to your question, we will follow up afterwards. So feel free to ask and then wait for us to get back to you. Again, my name is Justin Carlson. I'm the Chief Commercial Officer and founder here at East Daily. I've got with me Ajay Bakshani. He is one of our senior analysts, specifically focused on the financial sector, knows a lot about these companies, and is excited to talk to you about the marriage of that commodity analytics with that financial analytic aspect of what we have in the space. So we're going to go through. We're going to cover natural gas at first. Then we're going to dig into some NGLs, and then we're going to finish this up with crude. and talk again through those dynamics. So I will go a couple times, then Ajay will jump in here and talk about some of the financial implications. First thing was just some key takeaways. Three growth areas that I want to talk about with respect to natural gas that translates into that organic growth, but also translates into some inorganic upside for specifically in attachment to the LNG build out and how that's driving demand growth in the sector. Haynesville growth has been a topic of conversation over the last few months. Late last year, we talked about the oversupply situation. We talked about something's got to give. Our prognosis at that time was that the Haynesville have pulled back, and we've subsequently seen that. And while this is a short-term pullback in our minds and might create, a bit of a, some what are maybe even perceived as headwinds for these companies, it is temporary because there is hockey stick growth coming on the backside, and we'll talk about that, and that drives a significant amount of organic growth because these companies have put in infrastructure that might be capex additions today with respect to specifically some new build pipes that are just coming online now out of the Haynesville. But as as those pipes come online and we get into sort of that 24, 25 timeframe, all of a sudden these will be pipes that will be able to leverage organic growth to the extent they're not fully contracted now, which many of them are obviously heavily contracted. So, but the G&P systems backing those will get that organic growth. With the Permian, continued organic growth there, feeding downstream assets. There is long-term upside for the Permian. I think I've seen a lot of commentary in the market about, a flattening IP. I'm, personally not really worried about that. I see there's density of wells. There's still a ton of activity, and there's a ton of, and we'll talk about this in the NGL section, a ton of growth with respect to processing capacity additions and even pipeline additions that have been proposed out there. So, and we're going to have a joint webinar or another webinar about crude oil markets as a backdrop, driving Permian growth. 5 big reasons to be bullish and one big reason not to. We're going to do that at the end of the month on the 31st. So there's a link in here for that, or you can go on our website and sign up. But feel free. We'd love to have you join us then. There's also a past webinar, and again, you'll get this deck. You can click on that link there, the big squeeze, and I go into some very detailed, specific system level stuff. So click there. Again, I talk about significant inorganic growth here with pipe connectivity issues, as well as I'm not going to spend a lot of time today on storage, but we did a past webinar on that. You can tune in or click on here after you get it and listen to the replay there and see what's of interest. And then one thing that's not really built into our organic growth that I'll sort of touch on, but I think it's important to mention is we see a lot of opportunities longer term for tier 2 basins. That upside is not necessarily built into that organic growth because it's still to be determined where it will come from. But we need more volumes, especially to support LNG growth. So those are some key conclusions on sort of the commodity side of things. Ajay, why don't you launch into a few of the company side of things that you'll be discussing?
Yeah, thanks, Justin. So on the company side of things, obviously we see significant growth in the Haynesville, but really I think what's important is we're going to need to see continued investment to really take advantage of that hockey stick growth that you mentioned as far as production. So, the upside is primarily driven by pipeline investments rather than increasing G&P volumes. And I think we'll see that when we, talk about Williams and how they're taking advantage and positioning themselves for this future demand growth. On the Permian side, we see, positive growth across most of the G&P systems in the basin, but especially at Western and Targa, we really see them taking advantage of that, especially for Targa, moving those NGL volumes more downstream. It's really becoming a big driver for our forecast there.
Awesome, Ajay. And as I said at the beginning, I think we're gonna table the West stuff. I'd love to talk about West. I think it's really exciting. We're going to instead talk a bit more about Crestwood and Energy Transfer, but we'll include some slides in the appendix on West. And so dig through those slides once the deck is sent around, and you can take a look at those and see see what we might have talked about, and feel free to follow up with questions. So I like to start off with this super build. Several of you have probably seen it in previous decks. I've added a couple more arrows that I think are relevant to this conversation, but it just gives a good perspective of the actual dynamics at play here. And what's at play here is this 23, the phase we're in now, where we're getting long. We've obviously talked a lot about pressure on gas markets. We've seen the subsequent degradation in price. We've seen some offsetting help from a really hot summer, of which I don't know that I could make it in Houston, being a Colorado native. I think my body I might just sweat away. But the reality is we are still very long gas, and we've got a lot of infrastructure to fill. At the end of the year, we're going to get the PHP Whistler expansions to come across. We're going to talk about those a little bit, but those are investments that will help support continued growth, organic growth out of the Permian, and thus support our longer term forecast. Absent those, we would not see the growth in the organic growth in the G&P systems. We would not be able to put those in, to the extent that those were delayed, which I do not have any knowledge or notion that they're going to be delayed, just to make that clear. But to the extent something happened there, that would delay the organic growth that we have in our analysis. And then we got the Haynesville stuff that's coming online, and you can see that with, obviously we have Gulf Run that came online earlier this year, Acadian Enterprises system that expanded not too long ago, and then we're going to get towards the end, later this quarter, we're going to get, beginning of next quarter, we're going to get the first phase of the next expansion of LEAP. And what those will do is really tee up the basin for that hockey stick growth, so that as we see these, as we see Chesapeake and Southwestern and various other players in the Haynesville pull back, for now, we're going to see those pipelines enable them for some hockey stick growth. In one of our previous tipping point client-only webinars, we talked a bit about how that might lead to some basis dislocation between Houston Ship Channel and the growth that's coming out of the Permian, crossing the Louisiana border to meet some of those incoming LNG facilities in Louisiana, and how there's a gap there. I'm not going to spend a lot of time talking about that today, but to the extent that that's something that interests you, feel free to reach out, and we can talk about it, and certainly give you access to the webinar. The other thing that I wanted to throw in here, and this is a bit new from some of the recent maps, is this Dos Caminos, and then the Pecan pipeline, which is actually backed by EOG, right, Jay? Yeah. So with those two, originally we thought that EOG was behind Dos Caminos and was one of the drivers behind that. But when we saw some of the expansions of the Pecan and an EOG affiliate-owned pipeline at 1 BCF, we're not so sure about that. And Webb County, Texas, might be a bigger growth area than we'd originally counted on. And when you put those two in there, that's 3 BCF of gas that's going to all of a sudden show up in South Texas. That's in addition to the half a B of gas that's already showing up in South Texas. So again, there's some basis implications there that we won't get into today, because we're really focused on some organic growth discussions. But nevertheless, that's some incremental supply that's going to show up to feed some the LNG facilities. If we fast forward to 24 through 25, you get this slew of new Haynesville expansions. Again, those are all going to come down. You get the massive Matterhorn system, 2 BCF coming across for Permian. We'll talk about that in a little bit. That'll enable additional growth. The point of all of this, and if you sort of summarize it, is you get all this new infrastructure able to provide for organic growth out of the G&P systems within both the Haynesville, the Permian, and of course now down in the Eagle Ford, starting to play a bigger role, respective of the LNG facilities. So what I've summarized here on the top, you see 6.5 Bs of new infrastructure coming out of Haynesville. You see 3.1 Bs of new infrastructure coming out of the Permian. And then you've got this slug of LNG, 18.65 Bs of new LNG that we believe will come online as you look forward. They're making progress. I've seen tons of articles about the floating Delphin, the floating LNG facilities coming online, small, nevertheless, incremental demand that's coming online on the coast. You can see Corpus and Delphin and Commonwealth and the Plaquemines facilities all coming online and starting to provide that demand side. But the inorganic side of this is the 18.65 compared to the 10 Bs-ish of new pipe, 13 if you add the Eagle Ford stuff. We're still missing about 5 BCF of interconnectivity. And when you consider a lot of that interconnectivity is actually down in, or is actually up in Louisiana, then the connectivity between Texas and Louisiana isn't even there. So we're going to need more, and that's akin to the basis issue I talked about earlier. So we're going to need more infrastructure is the point on the organic side. So with that, I'm going to dive into some numbers here and talk about the Haynesville and what I call the give and go, which is, hey, we're going to give a little bit in this short term because Haynesville is the balancing. And then the go is you've got this huge hockey stick growth for the Haynesville that is absolutely, in our opinions, 100% necessary to support the demand side dynamics that we see for the, to support LNG as it comes online. Producers obviously have significantly cut that drilling in the short term. We're going to talk about some system level stuff and how that aligns there. But again, they're going to need that hockey stick growth in the long term. What's really fascinating here, and I want to point your attention to the sum of the two blue areas, which is our current balanced model for the Haynesville versus the black line, which is our unbalanced. In our supply demand products, we run two production models. We run the first where we just we let rig counts sort of drive production growth, and that's the black line. And then we have the balanced model where we say, okay, what does the sum of all the basins need to balance in order to meet our supply, global or national supply demand balance? What's fascinating here, respective of that pink area, which is where we were last November, is the black line and the blue area have come together. Last November, they were not that way at all. They were completely dislocated, and that's where we had a real price call on Henry Hub saying we need lower prices to decentivize production growth. Now they're together. So what we're saying here is in the short term, in that red box, we believe the market's relatively balanced. We've cut enough rigs to balance versus our demand expectations. So we're at a good level right now. What you see in the long term, though, is the balance now has become reversed, where our black line, which is based on where the current forward curve is, and that was what we believe how that's driving rig counts and drilling activity, is under that blue area, which means we actually need higher prices in those out years in order to incentivize more drilling activity back into the basin to incentivize Haynesville growth to feed those LNG facilities. So there's opportunity upside for organic growth in the long term, specifically for Haynesville players that may not be in the market. And then that big question mark at the end, which is, we sort of cap, or we don't sort of, we cap the Haynesville at some point and say, can we really support more than 90 to 100 rigs in that basin? The reality is we're not sure. It seems like a very dense area to put that much activity in there. So we cap it out, and that's where we start to look towards other basins like the Eagle Ford, like the Anadarko, like the Barnett, to come in and backfill some of that supply. Of course, that needs more infrastructure, as would the question mark growth area that Haynesville. Nevertheless, that's something we're going to continue to be watching. One last comment here, and then I will we'll jump into some financial pieces for the Haynesville players. Is East Texas, I get a lot of questions about East Texas and the growth there. We have 4 BCF of growth from 6 BCF to 10 BCF in 2030 for East Texas. That is not a small amount, and they still post an impressive 11 MMCF per day IP rate. That's what we're using in our models. Relative to the core of the Haynesville, yeah, that's somewhere in the 20s, I believe 22 if I'm not mistaken. But yeah, so it is definitely less. Sorry, it's not 22. It's 16. It's 60% of the Haynesville IP rate. So, but nevertheless, so it's about, I think, 18 or 19, I think. Nevertheless, that's still an impressive rate. So movement of rigs, which we did notice earlier in the year over to the East Texas, while it does lower some of the production trends, it does not eliminate it to the degree it would if it had gone to a much less productive basin. So that's it on the Haynesville. Again, I'm sure there's lots of questions about that, and we can dive into those. Again, today, if you filter, this is actually our company level comparative tool where you can look in our Energy Data Studio where you can compare companies. We filtered by nat gas, so we physically press the filter, hey, nat gas at the top there. And then you can't see it in the market segments because we've had to select a couple of things here, but this is targeted at the Haynesville and East Texas and that area. And so what you see here is 5 of the companies operating in that area. And obviously the 2 standouts from a growth perspective are ET and Williams. This is both organic and inorganic growth, which Ajay will launch into and start to talk about. Again, we're going to focus a bit on Williams here. Then we're going to talk about ET and Crestwood a bit as we get into the Permian. Digging into Williams, what's cool about their system, and you can see that growth rate there in orange, massive growth. They had that acquisition of Trace Midstream, which they got, Rockcliffe was a primary. You can see them in the bottom left there with 21% of that total sort of Magnolia Trace Midstream combined system. You can see in the upper right there, again, this is from our Energy Data Studio on our G&P system analysis. We have this lull in rigs, and then we have it rising back to the peak as we push more rigs into the market relative to what we need to balance the market, and the Haynesville being a primary balancer there. One thing to note about this, if you look at the graph on the top left, we've got this huge orange growth curve, and then you've got this blue line, which is the sample. Now, you'll see it in the notes here, but the sample's been deviating away from our growth curve more so in the past few years as more gas gets on intrastate systems in the area. Gulf Run in particular, a more recent addition earlier this year, beginning of this year, has actually started to separate that even more because we can't see Gulf Run daily flows. So that sample, which the market relies on heavily to gauge production growth on a real-time basis, is deviating, which is why we think it's so critical to watch the systems as a whole and the rig counts and running forecasts at a system level, which is what that orange area is. What I will say is you can see that blue area, that blue line is drifting a little bit away from the orange area. We're probably going to revise the Williams system down a bit. We think that there's a bit more DUCs. We still see strong rig counts on the system between, the 6 that are on the Magnolia system. You can see there on the left, that customers tab, the 6 that we're tracking on the Magnolia system versus the 3 that were Rockcliffe rigs that we're tracking on the Trace system. So I guess to sum it all up, we'll probably lower it a little bit, but not that drastic dip you see in the Haynesville. Currently, it'll just be a slight off tick. We'll probably come down a little bit. And then again, we still expect that hockey stick growth in the long term. We just think that there's more DUCs being built on system right now. And thus we're not seeing quite the production being added to the system that we would expect. But again, that's just options for the future, optionality growth for the future. The only other thing I'll mention here, and then we'll jump in, Ajay, and you can start to talk about some of the financials there, is you don't see Chevron in that mix. They had a 26,000 acre commitment dedication from Chevron. You can see that down at the bottom of the growth bullets there. So they'll start to make their way in the mix. Obviously, we see a lot of opportunity for Williams to leverage its interstate pipeline grid and its expansions on those to drive longer term value for the system, and this organic growth, which you can see highlighted in the graph there on the left, and the hockey stick that we expect to see for this system in the long term. They're going to be able to vertically integrate that into the rest of their overall infrastructure balance in order to drive EBITDA. So I will shut my mouth now and let Ajay take us away with some thoughts on how that impacts the financials.
Yeah, thanks, Justin. So when looking at our blueprint financial model for Williams, which models out the company asset by asset, it's really interesting to see that most of their growth is coming from the Haynesville. It currently makes up only 4% of EBITDA, but we expect this to grow to 10% by 2026. And that's excluding any uplift in earnings from Transco from the basin. So in reality, it is going to become a much more significant part of the company. So looking at the company's base business risk, it's almost entirely driven by the company's Haynesville assets. Now, for those of you who are new to East Daily, the base business risk, or BBR, is a metric we developed to measure the cash flow replacement risk for our coverage list. Now, in more recent years, we've actually seen existing assets in the ground get a lot more valuable and grow earnings, and it's more akin now to organic growth for a midstream company. So we define the base business risk as the sum of EBITDA change on legacy assets from 2022 to 2026. And we define a legacy asset as an asset that's been operational for the full base year, which is 2022. So we exclude any asset that comes online or has or had a major expansion or was acquired after the first quarter of 2022. One major exception to that is just any GMP plant additions to existing systems, since those usually aren't massive projects and they're similar to well-connect growth capex, as most companies will build as just customers grow volumes. So focusing back on Williams, if you remove the Haynesville legacy assets, the base business risk is zero, which isn't necessarily bad. It's essentially saying that we see little risk to the company's current earnings profile. However, its legacy assets in the Haynesville are actually driving growth for the company through 2026. And so this is primarily its Magnolia system in Louisiana. As you said, Justin, there may be some short-term risk if Haynesville volumes pulls back a little bit more. But longer term, the company already has assets in the ground that are well positioned to take advantage of this growth story. But the key thing with Williams, it's not just stopping there. It acquired Trace, which isn't part of the base business risk because it was only acquired in 2Q22, and it's building the Louisiana Energy Gateway pipeline. So the company is actively investing in the basin and leveraging itself more and more to this LNG demand story. So if you include Trace and LEG, almost half the company's growth is coming from this basin. Looking at some of the other companies like Energy Transfer, they also have similar tailwinds in the base business for assets that they already have in the ground, but they're outside of Gulf Run, they're not really actively investing a lot more in the basin relative to Williams. So in order to really take advantage of this growing Haynesville production, I would look to Williams. While a large portion of earnings still come from outside of the basin, it's a clear growth engine for the company and would be a good way to really take advantage of this growth.
Yeah, and you can even talk about some of their legacy assets being core assets, just in terms of, like, as you mentioned, Transco and Northwest Pipeline and a slew of other assets that are really core to the nat gas industry in general. So with Williams, you're not only getting that upside lift of having a strong base business growth in the Haynesville, but also being a core delivery mechanism for all nat gas across the U.S. space.
Yeah.
Awesome. Well, let's dig in. We're going to jump to the Permian here, and then once we get out of the Permian, we're gonna or not out of the Permian, we're gonna transition right from the Permian into a talk about the CEQP Energy Transfer merger. So that's an exciting shift that we'll make here for those of you that joined the call a little bit late. With the Permian, though, what I'll point you to is I did this graph a little differently. We talk about which gas is going to the east towards Houston, which is going to the north, which is going to Mexico, and we divide this graph in something that's not so colorful and has less colors and a little bit more distinct. But I wanted to show it this way this time, which is these are our forecasts by pipe. This is what we bake into our financial models for the analysis of these systems. Obviously, with gas pipelines, most of them, if not all of them, are really take or pay. So we're really more focused on the contract risk, less on necessarily the throughput. The throughput's a bit more of an indicator of where things may go with contracting in the future as contracts come up for expiration. But nevertheless, I want to show it this way because I really wanted to highlight that pink area, which is some of the new systems that we're building out of the Permian, and the fact that we expect that Matterhorn system to fill. It will fill at the expense of some of the other, predominantly northbound pipes. You can see those sort of shift in the bottom there as they start to lose a little bit of volumes, and the priority becomes, hey, can we send gas to Houston? Can we get those markets? That'll create some shifting balances across the rest of the market. But we do expect Matterhorn to fill. just the whole basin as a whole, as you can see, of that total sum of the area relative to that red line, right now we don't expect to fill. So there will be space, which means better basis opportunities, might mean some risk or will mean some risk potentially on the marketing side for companies like Energy Transfer, who have benefited from wide spreads in the past and having some marketing capacity on systems. They won't get that benefit in the near term. Just a distinction between the red and the black line. Black line is our nameplate capacity of all the systems leading. That is what they're physically marked as being able to ship. The red line is East Daly's effective capacity, which is this is what those systems can actually ship in our opinion, which is what drives basis. So to the extent that the red area or that some of the stacked areas match that red line, that's where we see risk of basis blowouts. We've been talking about this a lot. I'm not going to spend too much time on it today because we just simply don't have the time about, well, why haven't we seen, it looks super tight right now. Why haven't we seen that basis risk? And that's for a number of reasons that we've talked about in our client webinar that we did a few weeks ago, just with regard to ethane recovery, really hot weather that, ultimately impacts, recovery of ethane and also impacts demand. Both, probably underestimating Mexico demand as well. If it's hot in Texas, it's hot in Mexico. So, there's a number of factors there that are driving that and will help, likely help Waha escape a bit here from having quite the significant blowouts that we originally expected. Nevertheless, we still see a lot of growth in the area, and you can see that growth reflected in our continued uptick and/or potential upside in the long term. You can see in that red area at the very top that's stacked on is the last part above that yellow area. That's a flat rig scenario. So one thing to note, when we run our forecast, we're running the Permian in particular given the oil's backwardated curve, which means that we reduce rigs in the long term relative to the short term. I'll talk about that in the crude section of this presentation a bit more, but just to say that if we run it at a flat rig count, you do run out of effective capacity. You do need more pipes, and there's inorganic opportunities for Targa, with their Apex proposal, with Energy Transfer, who's got the Warrior Pipeline proposal. There's a number of other ones out there that have been at least floated in the past, and so there is opportunity out in that 26 time frame for more upside and for need for additional pipes. So again, for egress in particular, I know this is a big discussion about egress. Really, I want to talk about organic growth. I don't really see, let's say, that move in Matterhorn and the open capacity as any risk on any revenue potential for Permian egress pipes. I mean, these are contracted pipes that are take or pay, and we're going to see those systems continue to be contracted because of the potential of what you see here with the flat rig count, which is, hey, we can fill those right back up again, and it becomes a really profitable area. If we do the same filtering, so if we now take that Permian and do the same filtering on our company comparison dashboard, nat gas, but this time we select the Permian. So you can see in the top right-hand corner, we targeted the Permian. You've got some big players here. Targa, a significant amount of growth out of the Permian, for nat gas out of the Permian, ET, EPD. Again, we're going to spend a bit more time. At this point, we're going to talk some about Targa, them being the highest on the list here. But then we're going to transition right into ET. And instead of doing too much on ET's Permian play, we're going to spend a bit more time talking about that combination of ET and Crestwood. So with that, Ajay, why don't you, we're going to switch it up here a bit, and we're going to talk about some of the financial impacts first. And then we may dig into some of the Targa volumetric growth potentials, particularly for their Delaware system.
Yeah, so we'll be quick on Targa, but it's just hard to talk about the Permian without talking about Targa, given they have about 30% of the basin's rigs on their G&P systems. So for the company, it might be hard to beat, just looking at its Permian assets, it might be hard to beat 2022 from an EBITDA perspective, just given the incredibly high prices we saw. I think Waha was averaging close to $5 for 2022. And then we see that in the base business risk, that when you look at their Permian assets, it's actually going to decline relative to 2022, but that doesn't tell us the full story. And a big reason for that is their Lucid acquisition, which really just turbocharges their business even more. So they had a pretty big presence in the Permian before Lucid, and now it is by far the biggest in the basin. So outside of the Lucid system, again, we do see some EBITDA decline, but this is more price-driven than volume-driven. For that Lucid system, though, which I think you'll go into a little bit more detail, Justin, that really addresses a lot of the risk, any of that price risk at its existing systems. And that system is where Targa is mostly expanding. So the company is adding about 2.5 BCF a day of processing capacity, really since, I think, end of 2021 through 2026. A lot of that's going to be on Lucid, and a lot of that growth on the G&P side is actually going to drive down to Targa's NGL assets and its new Daytona NGL pipeline, as well as its 2 new fractionators, plus the Gulf Coast fractionators that it's restarting. So we'll get a little bit more in the weeds on those NGL assets later in the deck. But I think now is a good time to sort of really dig into what this Lucid G&P system entails.
Got it. Yeah, so we'll dig into the Lucid E&P system, but I do think you'll probably get into this a bit more with Energy Transfer, but there's definitely this, there's a bit of a tug of war.
Yeah.
I mean, Energy Transfer, Targa's done a fantastic job of growing their footprint and really leveraging, organic growth and their systems in the Permian in order to drive vertical integration through their NGL lines, as you talked about Daytona and the fractionators and down even to export terminals. So, and now we see, I don't know that it's a full counterattack, so to speak, and I wouldn't ever be thought of that way in when you talk about those two companies. But nevertheless, certainly with the Crestwood acquisition, there's some volume sort of grab back. Would you agree with that?
Yeah, definitely. And it's not just between Energy Transfer and Targa, but it was really Enterprise now in the mix as well. When they first acquired Navitas, then Targa acquired Lucid. And although Crestwood's more than just their Permian system, a big growth driver for them is the Sendero system that we'll get into. And that's definitely going to help boost ET's Permian G&P system as well as its downstream NGL pipes.
Yeah. Okay, we'll get into some consolidation with ET and Crestwood here in a second. Just quickly to highlight on, first I want to highlight with Targa and Lucid, you can see the backwardation of that curve there on the right, which is then, you can see it as the commodity price driver right there in the orange line relative to the rig count. You can see that correlation that we bake into the forecast, as I talked about earlier. We could, to the extent that we see rigs remain flat, price curves are always wrong. They just are. And so the reality is, and I talked about this with respect to the crude webinar that we're going to host at the end of the month, we see a lot of bullish opportunity to suggest that curve is going to be wrong and that it will be higher, and thus rigs will likely be higher. So that then translates into, if you look at that graph on the left-hand side with, Wildcat being built here, Roadrunner 2, this is a combination of their Delaware system as well as, their overall Delaware system. So that includes the Delaware system as well as the Lucid acquisition. You can see that in both those numbers there. And in fact, most of the growth, and I know it's a little hard to see, but you see sort of a line. There's this darker orange line between the areas there. A lot of that middle area is actually that Lucid system. So they're really getting all the growth at the, I don't want to call it at the expense of the Delaware system. I think the Delaware system plays an important role of that, but the volumes are largely being directed towards that Lucid system. One thing to note about this, it's the blue line there, and even the gray line. So the blue line is we're tracking the nominations again. It is well below the overall system, so you do not get roughly a little more than, let's say 55, 60% of the overall system we can actually see on a daily basis, or even historically you can correlate those two. But even if you look at the gray line, which is another data set we integrate into the analysis, which is the plant level inlets. And if we were to go into more detail here, I could show you the plants that sort of disappear from the Railroad Commission data that don't allow us to aggregate up to what the overall system is running, which is where we true that up into the orange area and say this is our benchmark for where we think the systems are actually running, and then our target analyst runs that through the financial models to make sure it all matches up with what they're reporting, the money that they're making, the average rates that they're getting. And so the point just being, it's triangulating these data sets is for us critical in terms of, validating what's information that has holes versus what's information that is more more accurate to what's actually going on in the basin. So we'll go into a lot of the detail here. I think we want to transition here. It's 10:40 now, Denver time. So I want to transition here into the CEQ discussion. But to the extent you have questions about that Lucid growth and the shifting of volumes, and the overlap between that Lucid system and the Delaware system, a lot of volumes here. And this is really actually how, Targa has been able to continue to expand Grand Prix, one of the systems that remains full, even when volumes were lower NGL volumes were lower and the basin had ample capacity. Grand Prix was running at full, and it's precisely because of graphics like this and ownership of a lot of those volumes on system that they're able to keep Grand Prix full and then even launch into an expansion. So with that, let's get to some of the fun stuff with respect to breaking news with Energy Transfer and Crestwood. So Ajay, go ahead and why don't you dig in there?
Yeah, so really topic of the day, this Crestwood Energy Transfer merger threw us into quite a spin this morning, which is exactly what you want the morning of the webinar. But it is interesting and, like you said, very relevant to our topic today. Crestwood scores the highest in our base business risk metric, and that's really driven by the excess capacity it has at its Bakken and Powder River systems. And so as we see continued rig activity and execution of its drilling agreements with its E&P partners, we expect a lot of volume growth on those systems at relatively low, that requires relatively low capex as well. So, Crestwood ranks at the highest. ET is also ranking pretty high, and so it does boost, the combined ET's numbers. Looking at the chart at the top right, you could see a lot of the growth is driven by its legacy assets, again, in the Bakken and Powder River. There is a big inorganic growth wedge, though, that comes from the acquisition of its Sendero system, which it acquired in 2022. And so that's going to be a big driver of growth, and it really fits in well with Energy Transfer's Delaware system, really extending it into the New Mexico area, as you can see in the bottom right chart. So I think it's that system that largely makes this an attractive deal for Energy Transfer. It also enters them into Bakken G&P, and the gathering connectivity could improve the outlook for the Dakota Access Pipeline as well. But this Sendero system, it adds almost 550 million cubic feet a day of capacity to its Delaware system, and similar to Targa, that also presents an opportunity for more NGLs to really flow through its Lone Star pipeline and to its Mont Belvieu fractionators.
And that Sendero system, if I recall correctly, Jay, I believe a lot of the NGL volumes actually feed into Grand Prix at this point, and so there's some competitive dynamics at play there, where Energy Transfer can now has a bit more of a foothold if this acquisition, pending this acquisition, has a bit more foothold to maybe grab some of those volumes back for Lone Star. Yeah, exactly. And I think the only question mark around that is just with timing. So currently, Targa, I believe, is actually offloading some volumes to the Sendero system. And with that, we saw tariffs from the Sendero plant for NGLs being canceled for everything except for Grand Prix. So as that offload agreement sort of ends this quarter, unclear on how long that NGL agreement lasts, but I think we could definitely see that move back to Lone Star. Got it.
So just taking us, walking us through some of our tools on EDS here on the next slide. This is our G&P comparative analysis dashboard. So you can see how Crestwood systems in the Permian overlap with Energy Transfers, and it really extends the company a little bit more into, I think that's Eddy County. So some interesting points here. There's some overlap as well. I mean, ET's new Bear plant is very close to Crestwood's Willow Lake plant. And another thing that I was thought was interesting was just the higher IP rates that we're seeing on this Crestwood system relative to the ET system. And then looking at our EDS G&P system analysis dashboard side by side on the next slide, we could really see how these two systems line up. So based on our data, it matches with what ET has reported as far as who Crestwood's biggest customers are in that basin, being Mewbourne, Novo, as well as ConocoPhillips, and it does have some room to grow further.
Interesting. Okay. Any takeaways, Ajay, that, from your perspective on, I know this is a lot about Permian and Permian growth, and any thoughts towards, just Energy Transfer being able to leverage Crestwood, out of Bakken and production there, and growth there, and how that feeds into their system. Obviously, ONEOK has a very strong foothold on the Bakken and the overall system through there. But any thoughts on the Crestwood side with respect to I think they have the Arrow system up in the Bakken?
Yeah. So on the gas side, it is an entry into the Bakken. ONEOK is dominant there, and there's plenty of takeaway capacity on the NGL side. So near term, I don't think that's going to be a massive opportunity for Energy Transfer, but I do see some opportunity on the crude side with them sort of acquiring more crude gathering assets. They also acquired some via their acquisition of Enable. So this really improves their crude gathering system in the Bakken, and you might see that might help them draw more barrels onto DAPL, especially as you do have some contracts rolling off DAPL over the next few years as you start hitting like the 7-year and 10-year mark on those initial contracts. So again, we see a lot of organic growth across Crestwood's Bakken assets, but where I do see some potential synergies is its ability to leverage those crude gathering assets to keep volumes high at DAPL.
Okay. All right. We'll transition off. Hey, for our clients, we'll be sending out a first take here on that whole acquisition, some of those overlaps. I'm sure we'll be talking about the BBR and the high organic growth that basically ET's proposing to acquire through Crestwood. We could talk through some of the options there, because it certainly exists and we see it. And as we mentioned earlier, it's one of the highest BBR measures that we have. So with that though, I'm going to shift here into some NGL stuff, given that we only have 12 minutes left, and try to hit on some of the highlights there. I'm going to go through this pretty quick. So in hopes that if you have questions that you can come back to us and ask about our expectations and dig in there. I mean, with NGLs, consistently strong reactivity, processing expansions, higher GORs driven by NGL production growth. The fractionation issue is not. We're going to see some tempered. We don't have that as big of an issue. That was a story we talked about a lot last year, and quite frankly, all throughout last year before the expansions came online. So that's not as big an issue. And now we're starting to see NGL pipes fill. And Ajay talked about it earlier with respect to the offload volumes that we've seen from Grand Prix, and we're shifting volumes. Systems can't even take enough gas or enough NGLs, and they're having to offload those to other systems. So, I guess the point of all of this is we continue to see stronger rig activity. We've been monitoring and looking at higher and expecting, that higher ethane recovery, primarily or a big part boosted by, exports and the strong drive in exports and the influence they're having on NGL markets, and how much like the gas side of things, NGLs are really reshaping exports. NGL exports are sort of reshaping the NGL side of the equation. Propane, a little bit different story there. We've got a bit of an overhang on propane, similar to gas, just with respect to weaker demand, but stronger exports are holding those up. So those are some things we're going to touch upon here in the next few slides. So, Ajay, anything on the key company conclusions you want to hit on?
Yeah, I mean, I would just, generally comment the NGL-focused companies, they are, performing, or they have better growth metrics than maybe some of the other, than overall midstream. Again, it's taking advantage of this Permian growth and growth elsewhere as well as, wells are slowly having higher GORs and more processing capacities being added. And then there's that big export pull, which we sort of see as the next sort of big frontier for these NGL companies. And we're seeing a lot of companies heavily invest in that. So we'll comment on that as well.
Just quickly on commenting on, again, I'm not going to spend a ton of time here. We'll move through this relatively quickly, but a lot of processing expansions that have been supporting that growth in the Permian. Certainly we've got a bunch that have been, that are upcoming, as well as, like Matador recently announced one. So they'll be expanding in the area. We've certainly got Targa's got Wildcat and Roadrunner, which we talked about before. West, which we did not get to talk about today, but is it going to be in the appendix? So check out the download later on and you can dig through some of those slides. And they've got Mentone and Mentone 3 in North Loving. Targa's got the Greenwood facility in the Midland. We didn't talk about their Midland assets. I find the Delaware ones in the Lucid acquisition a bit more interesting from a growth standpoint, but capacity in the Midland to take more volume. So the point of all of that is just simply that processing expansions continue to be a sort of leading indicator of future growth of the Permian that the midstream companies that expect, and that, on the back end, we've seen producers dedicate acreage to or dedicate commitments in terms of driving that growth. So we, as we're watching this, there is some ability to, relative to our forecasts, our backwardated curve forecast, there's overhead room there. So I think not only are we, not only do we see an opportunity for our 5 reasons, as I talked about the webinar that'll be on the 31st, do we see bullishness in the curve, which probably means we're underestimating that Permian organic growth. I think the midstream companies themselves see that, and the producers are backing or signing up and committing to, at least acreage dedications, volume dedications to growth in processing. The other thing I want to mention here is that, and I talked about it a little bit earlier, which is the fractionation side of things. You can see that in that bottom graph there, where the orange line is an indication of frac utilization. You can see it peaks above 100%. We've talked about this a bit in past webinars, just with respect to the ability to move above that 100% marker that there's the ability to leverage the facilities and optimize them a bit more than that sort of nameplate capacity. So that dipping down, as you can see with the recent announcement of expansions, Enterprise, Targa, others that get us into an 90-ish% timeframe, buys us some time until that 27 period where we do start to tap out again in terms of frac utilization. We'll, again, we're watching, could there be more frac expansions in the future? What does that translate to? So EPD, Targa, pipe expansions, they've got, supported by those acquisitions, as Ajay alluded to earlier, with respect to expanding Chinook and Grand Prix, and Targa with Daytona, Grand Prix, and then One Oak and their West Texas NGLB expansion, which is a bit of a, I don't know if it's a surprise to us, but I guess it's just more validation of the volumes that are behind there and the opportunity for continued growth there. So any other thoughts there, Ajay, before I launch into some discussions about ethane and then propane?
No, I mean, I think that sums it up well, Justin. As far as, sort of asset level constraints out of the Permian, we're really starting to see that focus shift towards the pipelines. And it's not, if you look at just the total, utilization of pipeline capacity out of the Permian, it doesn't seem constrained. It's really at these specific pipelines like Grand Prix and Chinook, and including West Texas LPG, where you know, those pipelines are specifically constrained, and rather than give those NGLs away, we're seeing expansions at those pipelines to, continue to take more and more barrels, even though it might not necessarily be needed.
Yeah, so it just shows the value of that vertical integration and really sort of owning and being able to capture the volumes right from the wellhead and then move them down the system.
Which I will add, just that makes it really interesting for ONEOK because they're not vertically integrated into the Permian. However, I think one opportunity for them and why they might still be able to fill up this West Texas LPG expansion is just the fact that, in the mid-2020s, we're going to have a lot of plant dedications roll off. So as you see a lot of the big Permian G&Ps like Targa, ET, and Enterprise, feed their own barrels, you might have third-party volumes or third-party plants look to ONEOK to maybe, give them maybe more favorable rate.
Oh, it's a good point that there's certainly be a scramble for marketing to some of those players as these contracts roll off. So something certainly to watch. With the ethane side of things, we've certainly seen a recovery from ethane, and you can see that on that yellow line on the left-hand side with respect to just how much ethane is being produced as we recover more ethane. It creates that overhead we talked about in the gas market. For every 1,000 barrels a day of ethane, we get about 28 MMCF per gas of space that's freed up on those lines, which then helps improve or maintain a stronger Waha basis, and we have the impacts from that. The other thing to note here is just that domestic ethane, which did weaken, that's that blue line or blue bars on the left-hand side. While it did weaken in the back half of 22, crackers went through longer turnarounds, and there were certainly some recessionary fears that were no doubt built into that pullback. But I think the recessionary fears has sort of faded into the background a bit more. We've seen ethane recover, so domestic demand recover at the same time. And it's hard to see here, but that orange, those orange bars on the bottom there's about a 17% or a 17% improvement year-to-date levels from 22 to 23 in terms of the export volume. So if you actually look at those independently, it's quite frankly, it's much more impressive than stacking it into this bar here. But ethane clearly is getting some more activity on the export side, and that's helping change the dynamic for the ethane markets. If you transition to the graph on the right there, one interesting thing is we've got PHP and Whistler expansions coming online, and what's sort of interesting about that is how that potentially could be impacting the frac spread, which you see from the orange dots on the right-hand side, where we've got this frac spread that weakens, while relative to the yellow dots, ethane prices themselves in the forward curve are pretty flat, which then implies that, we've got a strengthening, Waha basis in the future, and the natural conclusion is, that's driven by we've got PHP and Whistler coming online, improving gas prices, and thus making that frac spread not so strong. I'm a little, as we talked about earlier in the gas markets, I'm a little weary of that. I feel like we're going to fill those pipes relatively quickly. Again, I'm also cautious because we missed the sort of we expected Waha basis to blow out, and it's been able to hold strong due to the factors we discussed before with ethane rejection and heat. And, so anyway, I'm a little weary of that call, but I'm watching it very closely because I could also see the opportunity for ethane to rise subsequently because they don't want to lose those volumes. Again, as you look on that left-hand chart, we've got growing domestic demand. It's recovering back to, those peaks back in July of 22. We've got growing exports. I don't know that we can afford to lose the ethane. So perhaps even if we don't see a weaker, let's say, Waha price, I would expect we might see a stronger ethane price that offsets it. So it's not quite, falling, where that December 23 orange dot is really tanking below 5 cents there. That feels a little aggressive from a forward curve perspective. It feels a bit aggressive for the dynamics at play with strong ethane demand. And again, the potential that Waha still could get weak in the long run, or I guess I should say that differently because we're talking about Henry Hub prices, not necessarily Waha prices. But nevertheless, I want to, I'm not fully sold on that frac spread being as weak as it is out in time. Onto the propane side, and then we'll hit some financials here as we hit upon the hour. And I appreciate every one of you that can stay with us because we are running long. And I think, Ajay, if you're good, I'd like to just keep going through this. And hopefully, for those of you that can stay, you can stay. For those of you that can't and have to run to other meetings, please do look for the recording afterward. Maybe you can hop right back in here at the crude section. But, just on the propane side of things, propane exports have been really strong. You can see that in the blue area on the left-hand side. So that is holding up the propane markets despite a bit weaker, localized demand than we've seen historically. And so that has allowed propane to set that 14-plus week high marker. And you can see that by the right-hand side there where you've got that sort of average days of supply there. Staying really high, but note towards the end there, it's tabling off a bit. And we're starting to build a little of inventory. And again, that's a bit on the, on the weakening demand side here in the U.S. It's driving that longer term, though. If you look out in time, on the export side, China remains strong. They've got a number of new PDH units coming online, 6 of which already have 18 or so that are expected. That will continue to be a sort of balancer or bullish for propane and in particular LPG exports. And so that might be, it's something to look forward to in terms of, again, growing demand for U.S. LNGs, growing demand for Permian production, and a home for it. And again, we'll see what the winter brings with respect to potentially boosting some localized demand. So with that, I'll transition here to Ajay and let him talk through some of the financial pieces of it.
Thanks, Justin. So the NGL-focused companies really stand out when we, rank companies on base business risk and EBITDA growth. The mix between the base business and new project growth really splits the group. So we have ET and ONEOK that should be able to grow EBITDA significantly with limited new capex, as a lot of their pipes have some latent capacity that they can grow into. Enterprise and Targa, on the other hand, their pipes are relatively full, and we've already seen these companies have, embark on some larger projects like the Chinook expansion and Daytona pipeline to really take advantage of this Permian NGL growth. Note this was calculated before ONEOK's announcement of the West Texas LPG loop, as well as and the Elk Creek expansion in the Bakken. But really, that should drive additional growth and maybe move it a little bit more closer to Enterprise and Targa in terms of its capex spent. With the exception of ONEOK, all companies really continue to invest in exports, and that proves to be, again, the next big frontier for capex spend in the space. So you have ET spending $1.25 billion on its Nederland LPG export facilities, and they could expand its Marcus Hook ethane export capacity as well. And then Enterprise has announced a slew of projects, including a new NGL export facility at Beaumont. And Targa is currently expanding its Galena Park export facility slightly. So, given the growing demand for U.S. NGLs, I do expect continued investment in the space, and there's a big question mark if ONEOK enters the mix, but maybe with the Magellan merger, they'll have that expertise to do that, but it's going to be a big undertaking.
Perfect. Okay, we'll jump into some crude oil discussion here. We've got about 5 more slides, so let's call it 10 minutes or so, and then we'll sort of wrap it up here. Again, there's a question box to the extent you have them. I encourage you. I don't know how much time we're going to have for questions, but we will respond via email and or happy to do a call if you have one afterwards. So some key crude oil discussion points. Again, we've talked about Permian production growth. That's filling pipeline takeaway capacity. We're going to see that because it's definitely filling in a very logical order as we push volumes down to Corpus, and volumes then spill over into Houston and fill those export terminals. That creates organic growth for the unutilized capacity that already exists in pipelines and export facilities, and they're benefiting from that growth. The higher utilization, I feel weird about calling inflationary pressures and rate increases as organic growth. It feels a little odd, but nevertheless, it is part of the equation, which is that those higher utilization as well as the inflationary indexing of rates on pipelines will drive more revenue and is baked into our financial models to drive more revenue into some of these systems and all of the systems as they see upside from those lifts. So I do want to talk about that. The export terminal throughput, as I talked about, is expected to rise. And then the inorganic potential exists from both. There is scenarios that play out where we need more crude pipes as we start to run out of capacity, specifically with that, story on being bullish crude throughput, being bullish the Permian, higher production, and thus filling the pipelines that are in place. And then the upside potential for offshore exports and that those create with them being added. Obviously, that's not organic, that is inorganic, but nevertheless, it is upside potential that that starts to become very real for many of these companies. So, anything on the key company conclusion side of things, Ajay?
Yeah, I mean, main thing is we're really transitioning from an crude pipeline overbuild scenario to we're transitioning out of that finally. So we're seeing more interest around these crude assets. These assets that usually had EBITDA risk are actually now organically growing, and so we should especially see that from Plains and Enterprise, who have the newest pipelines out of the basin. But the other big thing that I want to touch on is just the marketing opportunities that's available now. As those pipelines fill, as we start to see spreads widen, we could start to see a return of crude marketing earnings, which have largely been a drag or at best, around, at best zero for these companies.
From a throughput standpoint, if that feeds into sort of this, the dynamics at play, then Ajay, from a growing throughput. Again, this is from our Energy Data Studio. These graphs there at the bottom, I know the numbers are a little hard to see, so I put the sort of the max there. You can get some perspective. The map there is a dynamic map that allows you to click on, which corridor you're looking at. And so on the left-hand side, I've got the graphic that represents the Permian to Corpus corridor, and on the right-hand side, I've got the Permian to Houston corridor. And then at the very top there, I've just summarized it from the pipe utilization standpoint so we can get a perspective of where they fit. Now, number one, pipelines above 90% utilization from that Permian to Corpus and are now spilling into this 10% FERC required walk-up capacity. There's a capacity that pipelines reserve for walk-up volumes. And so those, naturally are not on those long-term contracts and become a bit more of a, not, I won't call it a free-for-all, but definitely up for grabs for whoever wants to try to contract for those volumes, which means it's competitive. And so we're hitting that mark now, or really close to hitting that mark from a Permian to Corpus standpoint. And so that's what you see in that very top chart, and what you ultimately see, right there at that top chart, that number one, is we hit that 90%. What's interesting is that's coming at number two. At the exact same time, we see this huge drop off in cliff, huge cliff in the contracts that we're tracking and the expirations of those contracts on the crude pipelines. This is a bit of a unique data set to us as we scour the intrawebs and the presentations and try to find when these contract cliffs are for various crude pipelines. And what's important to note here is they're coming right. A lot of these parties are likely in the midst of negotiating, or just in the beginnings of talking about negotiating new contract terms. Again, at the same time when we've filled up that Corpus route. So it becomes a very valuable route. We've got inflationary pressures on rates. It'll be interesting to see how that plays out for some of these midstream companies as they're able to renegotiate those contracts and discuss the value of those. If you transition over into the Permian to Houston side, that number three represents that growth. So all that volume, we balance models, as I talked about at the very beginning of the value proposition for East Daily, is we're taking all of this Permian growth, we're flooding it into the most likely and economic corridor, and that's that Houston to Corpus route, and the ability to fill up, some of the larger ships at Ingleside and at SGT. or STG, excuse me. And then we move over into, now moving volumes into Houston. And those volumes you can see there continue to flood that market to the point to where Houston actually gets to, in that longer dated time period towards the end of 25, Houston gets to being completely filled at 90% utilization. So again, the point though is those volumes are flooding from the Permian, filling up Corpus. Now they're flooding over, filling up that Houston corridor and providing that organic growth. If we then flip over into that crude scenario, and I won't spend a lot of time on this, but that blue area is reflective of the crude production growth. You can see we table it out. Some might consider that conservative, some might consider that aggressive. If you really believe in the Permian sort of slowdown scenario with IP rates and whatnot. But if you stack on the light blue area, which is a flat rig scenario, what you get is something that matches very closely with PAA and EPD's own forecasts relative to their expectations. I actually think these are maybe a quarter old on PAA and EPD. So if those teams have come out with new ones, I believe they have actually. I need to get those in here. I wasn't able to do that before this presentation, but the point just being, we're really in sync there with respect to growth potential. And again, if that growth potential happens, then thinking back to this graph, you start to see more volumes flood into that Houston corridor, which is about, the difference is about 625,000 or 663,000 barrels, at 2027. That kind of fills the remaining pipeline capacity that we have available, and all Houston to Permian to Houston corridor is full. Volumes start to get dumped into Cushing. That creates wider spreads as we move crude oil around the Horn to ultimately get to those export terminals, which is where all the growth is. And you can see that here in this Next Energy Data Studio graphic here, where on the left-hand side, we have capped the ability Corpus's volumes. I'm sure they could probably get a bit more. There's probably some squeeze out we could get from Eagle Ford growth potentially as Eagle Ford picks up, but nevertheless, it's largely capped there, not by the physical constraint on the export terminals, docks themselves, as you can see by the red line, but by the physical constraint of the pipes that are able to serve that market. We start to run into some issues there with how much they can grow, which means that the volume growth for exports really shifts over into the Houston market. And you can see that, EPD, their Houston Ship Channel, Seabrook with Magellan, Nederland with ET, I mean, they really benefit from that pivot to Houston as more volumes flood into those terminals. And then longer term, the upside potential for how those offshore terminals may change the game for volumes now maybe being more incentivized because you can get lower rates. You don't have to deal with the reverse lightering that you have to deal with in Houston today. You get to those dedicated pipelines to those offshore terminals. I believe Spot can load 2 VLCCs a day or something to that effect. Don't quote me on that, but they've got a lot of capacity to load larger ships and ultimately get them out to those export markets. Spot in particular received that record of decision recently, which is a big move in terms of their moving forward and ultimately again changing the game with, hey, Houston now has 2 more facilities between Spot and then to the extent that Texas Gulf Link goes forward, to the extent that Blue Marlin's a bit different just with respect to the volumes it gets from Houston, but nevertheless, and maybe perhaps not as clean of barrels as you see from the dedicated lines going to Spot, but nevertheless, extremely interesting projects from how they might change the game in the Gulf. So with that, Ajay, I'll let you launch into this graphic here where we're looking at the crude side.
Yeah. So as far as Permian crude goes, the biggest players right now are Enterprise, Plains, Energy Transfer, and Enbridge. And I think Enterprise and Plains are especially interesting. And you could see that Enterprise actually takes over Plains in our forecast when it comes to Permian crude earnings. So moving on to the next slide, really just digging in a little bit more. Again, I mainly want to focus on what's happening as far as the pipeline, Permian pipeline volumes and marketing go. Since some of those major crude export projects are a little bit aren't FID yet and are a little bit more into the future. So I think one interesting thing when looking at the base business risk, the crude players actually look really good. So yeah, ET and Enterprise, they have some noise from other assets, particularly their NGL assets. But looking at Plains, I think that's just a good example of how the Permian crude story or crude asset exposure is going from being more of a cash flow risk to being a tailwind for the company. So its Wink to Webster pipeline will continue to drive earnings growth as commitments and volumes ramp up. And we should see rate improvement as well on its other pipes like Cactus II as spreads widen. We've actually already, starting to see that happen as the company got rid of the incentive rates on the Cactus II pipeline. Speaking of spreads, we could also see again a return of crude marketing earnings. So again, this was historically been a drag the last few years as there's just so much pipeline capacity and spreads between Midland and Houston were almost non-existent. And as these pipes start to fill, we should start to see that spread widen. So, and that should drive a lot of growth, or at least limit significant losses from crude marketing that we're currently estimating at some of these companies. So really entering a new era for these assets that they've been in the doghouse for almost 4 years now. And no one's really wanted to talk about crude infrastructure for a while, but starting late 2024, we really see that story changing.
Awesome. So, just to sum it all up, I mean, what I find fascinating about both crude, NGLs, as well as gas is, we've sort of been on this progression where, when gas is hot, crude is not. When crude is hot, NGLs are not. Like it's sort of this, I don't know, the switching of, whack-a-mole of what's interesting. We're now entering a period where I think gas has been getting really interesting. It will continue to be interesting as we develop infrastructure. At the same time, crude's starting to get interesting, and we have the potential to run out of capacity there, and we're building export terminals, and NGLs, continue to grow on the export side, and also we start to, see some expansions on that side where we haven't necessarily had that sort of dynamic at play in the past. We're going to be covering all of this in our daily notes. This is a free thing, so if you're not signed up, I encourage you to sign up and check it out. For our clients, we'll be digging into a lot of detail. As I mentioned earlier, look for the analysis that we're going to put out. The first take we're going to put out a little later this morning on SPOT and I'm starting to run out of steam here on Energy Transfer and Crestwood. So look for that. As I said, we've got a webinar coming up on the 31st with respect to crude. So look for that. We got a lot going on. We're going to continue to do a lot. We've got a brand new dashboard for our clients that really digs into gas pipeline contracts in a very unique way. So I encourage you, if you're a client, to check that out because it's free right now. It's on a trial prototype basis, so you can do what you want with it, get what value out of it, and leverage it now. So a lot going on. I encourage you to reach out, give us a call. We'd love to talk about this stuff. Thank you for joining us. Appreciate those of you that have stuck with us for as long as you have because we went over. So enjoy your day. Enjoy the rest of your week. Any parting comments, Jay?
No, thanks for listening. And if you have any questions, don't hesitate to reach out to Justin or myself.
Yeah, Jay Bakshani, Senior Analyst. I'm Justin Carlson, CEO here. We look forward to working with you in the future. Thank you very much.